The stock market is often misunderstood as a place where people gamble on prices, chase quick profits, and hope to become rich overnight. Stories of sudden fortunes frequently dominate headlines, creating the impression that successful investing is based on luck rather than knowledge. In reality, the stock market is something far more important. It is a structured financial system where companies raise capital and investors purchase ownership through shares. When you buy a stock, you are not simply purchasing a number on a screen. You are buying a small piece of a real business. Your investment becomes tied to that company's ability to innovate, serve customers, generate profits, and grow over time. Understanding this simple idea changes the way people view investing because it shifts the focus away from speculation and toward business ownership. One of the most important principles in investing is understanding risk. Every investment carries some level of uncertainty, regardless of how strong a company may appear. Stock prices are influenced by economic conditions, interest rates, global events, technological changes, competition, and investor sentiment. Successful investors do not try to eliminate risk completely because that is impossible. Instead, they learn how to manage it intelligently. They study the businesses they invest in, evaluate potential challenges, and consider how much risk they are willing to accept before making decisions. This process transforms investing from guessing into informed decision-making. The more an investor understands the risks involved, the more prepared they become to navigate both opportunities and setbacks. Another essential principle is long-term thinking. Many beginners become obsessed with daily market movements, checking prices constantly and reacting emotionally to every rise and fall. However, history has repeatedly shown that significant wealth is usually built over years and decades rather than days or weeks. Great businesses often require time to expand operations, increase profits, and create value for shareholders. Long-term investors understand that patience allows them to benefit from the natural growth of companies while avoiding the stress of short-term volatility. They recognize that time is one of the most valuable assets available to an investor because it allows temporary fluctuations to fade into the background, while long-term growth remains the primary focus. Diversification is another powerful tool for building a resilient investment portfolio. Concentrating all available money into a single company creates significant risk because one unexpected problem can dramatically impact the entire investment. By spreading investments across multiple companies, industries, and sectors, investors reduce their exposure to any single source of risk. Diversification does not eliminate losses entirely, but it helps create stability during uncertain periods. Financial markets are unpredictable, and even outstanding businesses can face unexpected challenges. A diversified portfolio acknowledges this uncertainty and provides a layer of protection against events that cannot be predicted in advance. This approach allows investors to participate in growth opportunities while reducing the potential damage caused by individual setbacks. Consistency and knowledge play equally important roles in long-term success. Many successful investors follow a disciplined strategy of investing regularly regardless of market conditions. Rather than waiting for the perfect moment, they continue adding to their investments month after month and year after year. This habit helps remove emotion from the process and turns investing into a systematic wealth-building activity. At the same time, they continuously expand their financial knowledge by learning about markets, businesses, economic trends, and financial statements. Finance is a skill that improves with education and experience. Investors who commit to learning often develop greater confidence and are better equipped to remain disciplined during periods of uncertainty and market volatility. Perhaps the most powerful concept in investing is compounding. Compounding occurs when investment returns generate additional returns over time, creating a cycle of growth that accelerates as years pass. Early progress may seem slow, and many people underestimate its impact because the results are not immediately visible. However, as investments continue to grow and earnings are reinvested, the effect becomes increasingly significant. This is why successful investing is often described as a marathon rather than a sprint. Emotional control, patience, and discipline become critical because investors must remain committed during both good times and difficult periods. Ultimately, the stock market rewards those who understand that investing is not about perfectly timing every market movement. It is about owning quality businesses, remaining consistent, allowing compounding to work, and giving time the opportunity to transform small, regular investments into substantial long-term wealth. If you want more insights into investing, financial education, and wealth-building strategies, continue exploring Wealth Finance 61, share your thoughts, and keep learning because financial success is built step by step, not overnight.